Welcome back to another episode of Journey TV. My name is Nick, and today we are talking about something incredibly important: how to spot cryptocurrency market manipulation. If you've been in the crypto space for any amount of time, you've probably seen wild price swings, suspicious pump and dump schemes, and maybe even influencers hyping coins that have mysteriously crashed days later. But what if I told you that much of what happens in the crypto market is not organic? Instead, it's carefully engineered by whales, insiders, and even exchanges themselves, all to simply manipulate retail traders and extract profits. Listen up. Market manipulation in crypto, it comes in many forms: spoofing, wash trading, front running, stop hunts, fake news, liquidity manipulation. Pick one. It's designed to trick you into making impulsive decisions. Unlike traditional markets where regulations help limit these tactics, crypto is still very much the wild, wild west, thus making it a playground for very bad actors. But if you know what to look for, you can spot these schemes before they trap you. In this video, we're gonna break down 15 of the most common crypto manipulation tactics, how you can stay informed, how they work, how to recognize them, and most importantly, how you can protect yourself. So whether you're new to crypto or maybe you're a seasoned investor, either or, understanding these tactics, it's essential to staying ahead of the game. So let's dive in and expose the hidden forces that are shaping the crypto markets. In the rapidly evolving world of digital assets, understanding thoroughly how these markets can in fact be manipulated, it is essential for any investor. Market manipulation refers to deliberate actions that are taken to deceive investors by artificially influencing the price or volume of a cryptocurrency. These deceptive practices can lead to significant financial losses for unsuspecting participants. The decentralized and often unregulated nature of cryptocurrency markets makes them specifically susceptible to such manipulative tactics. Unlike traditional finance markets, where regulatory bodies monitor and enforce rules to prevent manipulation, the crypto space, it operates with a higher degree of freedom. The environment can be advantageous for innovation, but also opens the door for bad actors to exploit vulnerabilities. Recognizing the signs of market manipulation is crucial for protecting your investments. By staying informed and vigilant, you can navigate the crypto landscape more safely. Throughout this series, we're going to explore common manipulation tactics, how to identify them, and strategies to safeguard your assets. Knowledge is your best defense against falling victim to any of these schemes. The psychology behind market manipulation, well, it's pretty big. Let's get into it, because at the core of market manipulation lies psychological exploitation. Here at Journey TV, we have often emphasized that successful trading isn't about charts and technicals. It is about understanding human behavior. Manipulators, they prey on emotions like fear and greed, creating artificial price movements that then lure traders into making impulsive decisions. Whether it's sudden price spikes or dramatic crashes, these engineered events manipulate sentiment to serve the interests of the few at the expense of the many. The crypto space, due to its high volatility and speculative nature, is a perfect playground for psychological manipulation. In traditional finance, market stability is maintained through regulations. But in crypto, on the other hand, it is often the wild, wild west. Manipulators understand that. Many retail investors, they chase pumps or panic sell at the very first sign of a dip. By crafting price patterns, they mimic natural market movements. They bait investors into traps, buying high and selling low. This is why understanding these patterns is vital for every crypto trader. Fear, uncertainty, and doubt, known as FUD, and fear of missing out, known as FOMO, are two of the most powerful psychological drivers in crypto. Manipulators strategically inject FUD into the market through negative news or social media campaigns, thus causing panic and sell-offs. Conversely, they generate FOMO through misleading hype, artificially inflating prices to trap late buyers. At Journey TV, we always stress the importance of stepping back and analyzing objectively and never, ever, ever making an emotional decision in the market. Understanding the psychology behind market manipulation is the very first step in resisting its influence. Let's talk about those pump and dump schemes, the classic manipulation tactic. Maybe one of the oldest and most notorious forms of market manipulation. Journey TV has covered these extensively because they continue to be one of the biggest traps for unsuspecting investors today. The pump and dump scheme works by artificially inflating the price of a cryptocurrency, often a low market cap altcoin, through coordinated buying and hype, only for the manipulators to then sell at the peak, leaving the retail investors holding the worthless bags. These schemes have unfortunately been rampant through crypto, exploiting the speculative nature of the market. The mechanics of a pump and dump, they're simple. A group of insiders or whales quietly accumulate a cryptocurrency at a very low price. They then begin a coordinated marketing push, leveraging social media, influencers, and fake news to all generate excitement and FOMO among retail investors. As the hype builds, unsuspecting traders then rush in, driving the price even higher. And at the peak, the insiders dump their holdings, crashing the price and then leaving the retail investors holding the bag in the red. By the time most people actually realize what in the heck has happened, the manipulators, they've already cashed out. Spotting a pump and dump is key to protecting your capital. If you see a little known cryptocurrency suddenly skyrocket in value with absolutely no fundamental news to actually justify it, watch out. Stay away, because that is a major red flag. Other warning signs, they include Telegram or Discord groups organizing mass buy-ins, anonymous influencers pushing a coin aggressively, and price surges followed by extreme crashes. At Journey TV, we always emphasize do your own research. Always. If something seems too good to be true in crypto, it usually is. Let's talk about that wash trading. Ever heard of it? Well, it's the illusion of market activity. More specifically, a practice where traders execute buy and sell orders with themselves to create the illusion of high market activity. Journey TV has seen how wash trading inflates trading volume on exchanges, unfortunately making certain coins appear more popular and liquid than they actually are. The goal is to attract retail investors who actually assume that the high volume means strong market interest, when in reality, it's just smoke and mirrors. Wash trading works because most crypto exchanges, especially unregulated ones, do not have strict enforcement against it. Market makers, project teams, and even the exchanges themselves can participate in wash trading to pump up their reported volumes. So do your own research. By making it seem like a coin is experiencing a surge in demand, these exchanges bait traders into jumping in, thinking that they're catching an emerging trend, when in reality, no real buying interest actually exists. And once the artificial trading actually stops, the price collapses. Spotting wash trading, it requires a keen eye. If the asset suddenly shows huge spikes in volume without corresponding price movement, it's a major red flag. Another telltale sign is perfectly mirrored buy and sell orders of the same size, happening repeatedly. No genuine traders would ever behave this way. Here at Journey TV, we always advise investors to please look beyond surface level metrics. Just because an exchange reports high volume does not mean that the volume is real. Always cross-check liquidity across multiple platforms and use independent data sources to verify authenticity. Another deceptive tactic that Journey TV has seen play out in the crypto market is called spoofing, a strategy where manipulators, they place large fake buy or sell orders to trick traders into reacting. These orders create the illusion of demand or supply, influencing market sentiment. However, the moment real traders respond, the spoofed orders disappear, leaving the investors trapped in an artificial price movement. This is a major issue in crypto because, unlike traditional markets, there is very little enforcement against it. Spoofing typically happens in order books, where large buy or sell orders are placed at key price levels to create the illusion of support or resistance. For example, a whale might place an enormous buy order slightly below the current price, making it seem like strong demand exists. Retail traders, seeing what looks like institutional accumulation, jump in to buy, expecting a price pump. But hold the phone. Before the price rises, the manipulator cancels the order and sells into the buyer's demand, profiting while others take the losses. Detecting spoofing, it requires paying close attention. The market depth and order book behavior. If you see massive orders that keep appearing and disappearing without getting filled, it is a clear red flag. Another sign is when price moves suddenly reverse despite what seemed like strong support or resistance. We at Journey TV always remind investors not to trust the order book at face value. Many of the large orders that you see may be nothing more than manipulation tactics designed to trap you. Instead, focus on price action and liquidity depth to make more informed decisions. Another brutal but common market manipulation tactic is stop hunting, a strategy utilized by whales and market makers to trigger stop loss orders and liquidate leveraged positions. Journey TV has seen this tactic devastate traders, especially in high leverage environments like perpetual futures trading. The goal is simple: push the price to a level where a large number of stop loss orders or liquidation points exist, force a cascade of automated sell orders, and then buy back at a lower price. Stop hunting, it happens because many traders place their stop loss orders around predictable support and resistance levels. Large players then exploit this by temporarily pushing the price below a support level, triggering a wave of stop loss sell orders. This forced selling drives the price down even further, causing panic among retail traders. And once the price has dropped enough, the manipulators then step in, buy at the bottom, and let the price recover, profiting from the volatility that they just created. The best way to avoid stop hunting? Be strategic with your stop loss placements. Journey TV always advises against placing stops at obvious psychological price levels, such as round numbers or previous lows. Instead, consider using a wider range or incorporating manual risk management rather than relying on automatic stop loss orders. Additionally, monitoring liquidation heat maps can help you see where large clusters of stop orders exist, thus allowing you to anticipate potential manipulation zones. In crypto, knowing when and where manipulation may or may not happen can be just as valuable as knowing which assets to trade. One of the most insidious forms of market manipulation in crypto is front running. It's where insiders or privileged traders use advanced knowledge of large orders to place their own trades ahead of them. We have seen this play out time and time again in both centralized exchanges and decentralized finance, where market makers, exchange insiders, and even bots, yes, bots, exploit retail traders by executing transactions milliseconds before theirs. This incredibly unfair advantage, it allows frontrunners to profit at the expense of everyday investors. On centralized exchanges, front running happens when insiders or high-frequency traders detect incoming large buy or sell orders. They quickly then place their own orders ahead of them, causing the price to move in their favor before the original order gets executed. By the time retail traders' orders go through, the price has already moved, often at a worse rate. In DeFi, this problem is even more rampant due to the transparent nature of blockchain transactions. Bots, oh those good old bots, they monitor the meme pool where pending transactions sit before confirmation and place trades first, squeezing out unsuspecting users and profiting from their slippage. Avoiding front running requires strategic execution. Here at Journey TV, we always recommend using limit orders instead of market orders, as market orders are more vulnerable to front running. In DeFi, utilizing privacy-focused transaction methods or adjusting slippage tolerance can in fact help you reduce the chances of getting front run by an MEV, or commonly known as a maximal extractable value bot. An MEV, yes. Additionally, traders should be wary of exchanges with histories of insider manipulation. Be wary, extra wary, and do your own research. By understanding how frontrunners operate, you can take steps to level up the playing field and keep more of your profits. You ever heard of fake news? How about social media manipulation? I'll take that as a yes. Because in the crypto world, among many other worlds, narratives, they move markets, and manipulators unfortunately know this all too well. One of the most effective ways to influence price action is in fact through fake news and social media manipulation. Journey TV has seen this tactic used time and time again, whether it's a false rumor about institutional adoption, exaggerated claims about regulatory crackdowns, or maybe outright fabricated partnerships, maybe all of the above. These deceptive narratives, they create FOMO or FUD, thus causing traders to make rash decisions. The rise of Twitter, X, Reddit, Telegram, Discord, you pick one. As primary information sources for crypto, it's made it easier than ever before to spread misinformation. Coordinated groups can flood social media with bullish or bearish narratives, then making retail investors believe a major event is about to unfold when it's not. A classic example is the fake partnership announcements. Projects have falsely claimed collaborations with big names like Microsoft, Amazon, many others, thus causing their token to skyrocket. Once the news is exposed as false, the price crashes, leaving those who bought in on the hype holding the bag. To avoid falling victim to fake news manipulation, always verify sources. Journey TV recommends, please, checking official announcements from company websites, cross-referencing multiple reputable news outlets, and being skeptical of anonymous social media accounts that are pushing extreme narratives. Additionally, be cautious when influencers are aggressively promoting a coin without transparent reasoning. Crypto moves fast, very fast, and misinformation, unfortunately, spreads even faster. Being diligent with fact-checking can save you from making very costly mistakes. How about liquidity manipulation, the hidden hand controlling price action? It's one of the more subtle but powerful forms of market manipulation, and it's the strategic addition or removal of liquidity to control price movements. Here at Journey TV, we have seen how whales, market makers, and unfortunately even exchanges themselves have utilized this tactic to dictate price action. By adjusting the availability of buy and sell orders, they create artificial scarcity or excess supply, thus forcing traders into disadvantageous positions. In low liquidity markets, even small orders can cause dramatic price swings, making these assets prime targets for manipulation. Whales can remove liquidity from an order book, creating thin trading conditions where a single buy or sell can trigger exaggerated movements. This forces retail traders to then buy at inflated prices or even sell at artificially low prices. On the flip side, large liquidity injections at key levels can make it difficult for prices to move past certain barriers, creating false support or resistance zones that trap traders. To protect yourself from liquidity manipulation, always check the order book depth and the trading volume before entering a position. Here at Journey TV, we always recommend avoiding assets with extremely low liquidity as they are easier to manipulate. Additionally, using decentralized exchanges, known as DEXs, with stable liquidity pools can in fact provide more transparency compared to centralized platforms that may be engaging in behind-the-scenes order book adjustments. Being aware of liquidity dynamics helps traders avoid unnecessary slippage and manipulation traps. You ever heard of a rug pull or an exit scam? Because few things are as devastating in the crypto world as an exit scam or rug pull. It's when project founders or insiders abandon a project after extracting as much value as possible. Journey TV has covered numerous high-profile rug pulls where investors were left with worthless tokens after teams suddenly disappeared. These scams often start with the hype, grand promises, and don't forget the artificially inflated prices, only to end with developers vanishing and liquidity drained overnight. Rug pulls typically happen in low regulation environments, particularly within DeFi and NFT projects. The most common type involves liquidity pool manipulation, where developers create a token, attract liquidity from investors, and then remove their share of the liquidity, making it impossible for holders to sell. Another method involves pre-sale and ICO scams, where early investors buy in, only to see the team dump their holdings after launch. Some projects even implement malicious smart contracts, ready for this, that prevent users from selling while insiders are cashing out. Spotting a potential exit scam, it requires thorough due diligence. Journey TV always advises checking if a project has fully audited smart contracts, researching the team's background, and looking for locked liquidity or vesting schedules that prevent early dumping. Be especially wary of projects with anonymous developers, promises of guaranteed high returns, or sudden spikes in price without real utility. In crypto, remember, if something looks too good to be true, it probably is. Never invest more than what you're willing to lose in unverified projects. Let's talk about insider trading. Insider trading is one of the most unfair advantages in both traditional finance and crypto markets alike. Journey TV has seen multiple cases where project teams, exchange employees, or connected individuals trade on non-public information, positioning themselves ahead of major price movements. This form of manipulation, it is particularly rampant in crypto because the industry lacks the strict oversight seen in stock markets, making it even easier for insiders to exploit their privileged access. One of the most common forms of insider trading is crypto. What? One of the most common forms of insider trading in crypto occurs before exchange listings. When a new token is about to be listed on a major exchange like Binance or Coinbase, just to name a few, insiders who know about the listing in advance secretly accumulate large amounts of said token. As soon as the public announcement is made, the price skyrockets due to retail FOMO. And insiders? Well, the insiders then dump their holdings at the peak, profiting massively. A similar scenario plays out with protocol upgrades, partnerships, and don't forget those little old things called regulatory announcements, where insiders position themselves before the news goes public. To minimize the risk of being a victim of insider trading manipulation, avoid chasing hype-driven pumps, especially after a major announcement. Journey TV always recommends waiting for a potential post-hype correction. Always wait for the potential post-hype correction before making a move. Additionally, tracking wallet activity of project insiders utilizing blockchain explorers or on-chain analytics can sometimes reveal suspicious accumulation before the big news drops. While crypto markets may be decentralized, information asymmetry still exists. So being aware of insider trading patterns can help traders avoid becoming exit liquidity. Let's talk about these flash loan attacks. It's instant market manipulation, and by far one of the most sophisticated forms of market manipulation in DeFi. The flash loan attack is a method where attackers borrow a massive sum of capital in an instant to exploit vulnerabilities in decentralized protocols. Journey TV has covered cases where these attacks have resulted in millions of dollars lost in a matter of seconds. Because flash loans require no collateral and execute within a single blockchain transaction, they tend to offer manipulators the perfect tool to distort prices, drain liquidity pools, and profit off of temporary price imbalances. Flash loan attacks often target oracles and DeFi liquidity pools. For example, an attacker might borrow a large amount of a token through a flash loan and use it to manipulate an oracle price feed, causing an artificial price spike or a drop in price. This false price can then be exploited in lending protocols, allowing the attacker to borrow more funds than they should actually be allowed to, before immediately selling and then exiting their position. Since the entire process happens within one transaction, the attack is completed before anyone can react, leaving the protocol and its users at a loss. Protecting against flash loan attacks, it requires stronger smart contract security and decentralized oracles that aggregate prices from multiple sources. Journey TV always advises traders to please be cautious when interacting with low liquidity DeFi platforms, as they are the most vulnerable to flash loan exploits. Additionally, looking at past incidents of manipulation in a protocol's history can in fact help you identify platforms with weak security. As DeFi continues to evolve, so do the strategies that are utilized by the attackers. Staying informed is the best defense against these instant manipulation schemes. So what is the role of exchanges in market manipulation? While many traders assume that manipulation comes from only whales and bad actors, unfortunately, we have seen crypto exchanges themselves engage in manipulative tactics. Unlike traditional stock markets, where exchanges operate under strict regulations, many crypto exchanges have little oversight, thus allowing them to engage in tactics exactly like wash trading, front running, liquidity manipulation, artificial liquidation sweeps. Pick one. These practices give them an unfair advantage over retail traders who simply assume that they are trading in a fair market. One of the most notorious manipulation tactics is forced liquidations. It's where exchanges intentionally drive prices to liquidation points to collect fees and liquidate over-leveraged traders. This is especially common in futures trading, where price movements can be exaggerated due to the thin order books and high leverage positions. Exchanges can also shadow ban or even delay withdrawal requests during critical moments. Robinhood? Anyone? All too familiar. Anyways, preventing traders from exiting their positions while prices, unfortunately, as we saw during COVID, move against them. To protect yourself, always be cautious when trading on unregulated exchanges with histories of manipulation. Journey TV always advises traders to utilize multiple data sources to verify price feeds, as some exchanges, they have been caught reporting different prices than the broader market to manipulate traders. So do your own research. Additionally, please consider utilizing DEXs, decentralized exchanges, for greater transparency, as on-chain trading eliminates much of the hidden manipulation that happens behind closed doors in centralized exchanges. In crypto, sometimes the biggest manipulators are the ones running the platforms. So now that we've broken down the most common forms of crypto market manipulation, the big question is, how can you protect yourself? Well, at Journey TV, we always emphasize that knowledge is the best defense. By understanding what manipulation looks like, traders can then avoid falling into traps set by whales, exchanges, and bad actors alike. The key is to remain skeptical of sudden price moves, misleading narratives, and don't forget that artificial trading volume. One of the best ways to spot manipulation is in fact by looking for abnormal trading patterns. If a token with little activity suddenly experiences massive spikes in both price and volume without any fundamental news, watch out. It's a major red flag. Just like large buy or sell walls that appear and disappear in the order book, well, that could indicate spoofing, so watch out. Traders should also be cautious of social media hype cycles, where influencers and anonymous accounts aggressively promote a coin with unverified claims. This often signals a potential pump and dump scheme. Be wary. To avoid getting caught in these traps, always verify the information before making any trades. Journey TV recommends checking on-chain data, liquidity depth, and historical price movements to all confirm whether a price surge is organic or manipulated. Additionally, please be sure to utilize decentralized platforms and reputable exchanges so you can avoid the risk of being exploited by insider manipulation. Lastly, never ever trade based on FOMO or panic. Taking a step back and analyzing the market objectively, well, it is one of the best ways to avoid becoming exit liquidity for bad actors. So after exploring the many ways crypto markets are manipulated, one thing is clear: staying informed is the best defense. At Journey TV, we always emphasize that crypto is a game of knowledge and patience. The market is full of opportunities, but it's also full of traps. By recognizing these tactics that are utilized by the manipulators, whether it's pump and dumps, wash trading, spoofing, front running, or exchange-driven liquidation hunts, traders can avoid unnecessary losses and make smarter, more informed decisions. The truth is, manipulation it's not going away anytime soon. The crypto industry is still very young, with fewer protections than traditional financial markets. Regulators are slowly catching up, but in a decentralized world, it's up to the individual traders to take responsibility for their own security. That means doing deep research, avoid emotional trading, and utilizing the right tools to spot manipulation before it happens. Following on-chain analytics, checking order books for irregularities, and avoiding hype-driven trading are just a few ways to stay ahead. Ultimately, crypto rewards those who think independently and do not blindly follow the market trends. Journey TV has always encouraged viewers to please do your own research and develop a trading strategy that is not easily influenced by external noise. The best traders, they're not the ones who chase the biggest pumps. They are in fact the ones who understand the game and play it strategically. By staying vigilant, thinking critically, and avoiding emotional decisions, you too can outsmart the manipulators and thrive in the crypto markets. That wraps up our deep dive into crypto market manipulation, the hidden forces that shape price action and catch traders off guard. If you've made it this far, you now have the knowledge to spot manipulation before it happens and avoid becoming exit liquidity for whales, insiders, and bad actors. At Journey TV, we always emphasize that in crypto, knowledge is power. The more you understand these tactics, the less likely that you are to fall for them. Please remember, do not trade based on hype, panic, or FOMO. Always do your own research. Analyze market trends objectively and utilize tools like on-chain data and liquidity tracking to confirm whether a move is real or manufactured. The best traders aren't the ones who chase every pump. They're the ones who stay patient, recognize manipulation, and make calculated decisions. In crypto, the game is rigged against emotional traders. So please, do not play their game. Make them play yours. If you found this video helpful, hit that like button, subscribe to Journey TV, and please turn on notifications so you never miss a crucial market insight. Drop a comment below, and please do let us know, have you ever fallen for market manipulation? What is the biggest crypto scam or shady practice that you've ever been subjected to, or maybe witnessed? Let's keep this conversation going and help more traders stay informed and safe. Thanks for watching, and as always, the future belongs to those who prepare today. We'll see you next time on Journey TV.